What is a retail investor? Many people may need to know the answer to this question. A retail investor is someone who invests in individual securities as opposed to investing in mutual funds or other types of pooled investments. They are essential because they help to drive the market and provide liquidity. In this video, we'll go through the function of retail investors in further detail and explain why they're so crucial to the market. What are the three types of investors? Short-term investors focus on short-term gains and often look for quick returns. They are typically very active in the stock exchange, taking advantage of price movements and buying or selling stocks quickly. Long-term investors. Long-term investors focus on long-term appreciation and growth potential. They may hold their investments over many years to build up a large nest egg in the future. They tend to have a more diversified portfolio than short-term traders. They will invest in different markets and sectors to spread out risk. Passive investors. Passive investors are the opposite of active traders. They typically buy and hold investments for the long term, relying on dividends and capital gains to increase their wealth over time. Passive investing requires minimal effort and is often suitable for those with a low-risk appetite. Why are retail investors important? Retail investors can provide essential liquidity to the market. When a company's stock needs trading for it to be bought and sold, retail investors can fill this need. It is crucial for smaller companies. Retail investors also create a more efficient market by providing price discovery. They help set the price of stocks by buying and selling shares in response to changes in the news or sentiment about particular companies. Furthermore, when large institutional buyers enter the market and try to purchase huge blocks of stock at once, retail investors can ensure they take more control of prices. To learn more about investing, check out our previous video. What is the role of retail investors? Regarding retail investing, it's essential to have realistic expectations and understand that there is always risk associated with investing. Retail investors are a vital part of the financial system. They provide liquidity to markets by trading in and out of positions, providing competition for big institutional investors and helping determine stock prices. Retail investors also help to increase market efficiency, as they often bring informed opinions about specific stocks or sectors that larger institutions may overlook. Moreover, retail investors are essential because they help drive innovation in the market, pushing companies to innovate and offer better products and services. The equity market is a crucial part of every economy. It allows businesses to raise money by issuing equity shares and will enable investors to make money by buying and selling stocks. Therefore, it's essential for anyone interested in investing to understand the vital role of individual investors in the stock market so they can make informed decisions when investing their money. With proper knowledge and innovative trading strategies at your disposal, you will be on your way to reaping the rewards of being a successful investor. Are you interested in becoming a better trader? If so, you have come to the right place. Read on to learn about a tool that can help level up your trading. Affiliate disclaimer: Moovmynt is supported by the people. When you purchase through links on our site, we may earn an affiliate commission that helps support our website and its content. Learn more. TradingView is an incredibly advanced and intuitive trading platform. Whether you're just starting out or looking for some help improving the strategies that work best with your budget, there's everything anyone could need here. Check out TradingView today. To learn more about technical analysis, check out our previous video. Do retail investors make money? Yes, retail investors can make money. However, their success depends on various factors such as knowledge and experience, risk appetite, and the ability to pick winners in the stock market. The retail investment market is a vital part of the overall stock exchange. By providing capital for growth and liquidity, retail investors help companies expand and improve the efficiency of the markets. In addition, investors can individually shape the market by affecting prices and voting on business decisions. Retail investors informed about markets, sectors, and individual stocks have a greater chance of success than those who buy and sell randomly. Additionally, retail investors must manage risk carefully to avoid significant losses. With the right strategies and discipline, retail investors can make money in the stock market. Who are individual retail investors? Individual retail investors invest in individual stocks and other financial instruments. They may be knowledgeable about markets and have experience investing, buying, and selling stocks without much research. Retail investors can range from beginner to professional investors. No matter their level of expertise, retail investors should approach the stock exchange cautiously and develop an investment strategy that works for them. For those seeking to invest successfully, it pays to educate yourself on the markets and develop a strategy that suits your individual needs. With the right approach and resources at hand, retail investors can successfully navigate their way through the stock market. Retail versus institutional investors. What are the differences between retail and institutional investors? The main difference between retail and institutional investors is the size of their investments. Retail investors typically invest only a small amount of money. In contrast, institutional financiers include large entities such as pension, mutual, or hedge funds that invest millions or even billions of dollars at once. Another key difference between retail and institutional investors is the type of investment strategies they employ. Retail investors tend to focus on short-term gains. On the other hand, institutional financiers have a longer time horizon and are more concerned with long-term growth possibilities. Retail investors often need more access to information about markets and stocks. In contrast, institutional investors are often thought to affect stock prices more than their retail counterparts. Under the sheer size of their holdings and their propensity for long-term investing, they are believed to have a more significant influence on the market. They can access specialized research reports, which gives them an edge in the market. Moreover, institutional investors are constantly developing new investment products that appeal to all types of investors. It helps stabilize the market and keep prices closer to fair value. By contrast, investors individually are more likely to buy and sell stocks impulsively, which can cause prices to fluctuate more dramatically. Overall, institutional investors significantly affect stock exchange prices more than individual investors. However, it's important to remember that both groups play an essential role in today's markets. Retail investors add liquidity and help keep prices closer to fair value. In contrast, it develops new products and helps stabilize the market. How do the two types of investors approach the market differently? Retail investors tend to focus on short-term gains by trading stocks frequently and investing in high-risk assets or penny stocks. They are more likely to take significant risks with their investments in hopes of quick returns. On the other hand, institutional investors prefer long-term strategies such as buying and holding stocks for years and investing in safe, well-established companies. They also have access to specialized research reports, which give them an edge when making investment decisions. In conclusion, retail and institutional investors approach the stock market differently. Still, both play an essential role in today's financial markets. Retail investors add liquidity to the market, while institutional investors can influence stock prices by developing products that cater to all investors. By understanding the differences between the two, investors can develop more effective strategies. Which type of investor is more successful in the market overall? Some people prefer to invest their own money, while others prefer to invest other people's money. It is impossible to say which investor is more successful over time because of both retail and institutional investors. That said, institutional investors have a much higher success rate due to their access to better information and resources than retail investors. Furthermore, institutional investors often have teams of experienced professionals who monitor markets and stocks around the clock and devise sophisticated strategies to maximize returns. This gives them an edge over retail investors who may not have such resources. Have you heard about cryptocurrencies? They are a new type of investment that is changing the way that investments occur, but it is vital to keep them safe to avoid them getting stolen by hackers. If you are looking to keep cryptocurrencies safe, then it is vital to invest in a hardware wallet. Out of the numerous options, there is one that we wholeheartedly recommend. Affiliate disclaimer: Moovmynt is supported by the people. When you purchase through links on our site, we may earn an affiliate commission that helps support our website and its content. Learn more. Ledger wallets are considered to be a very reliable cryptocurrency wallet option. They provide strict safety measures that ensure no compromise during transmission, making them an excellent choice. Check out Ledger wallets today. If you want to learn more about hardware wallets, check out our previous video. How retail investors shape the market. Retail investors have a considerable impact on the economy and stock markets. One of the most critical decisions a retail investor needs to make is when to sell stocks. They bring liquidity to the needs by buying and selling stocks, providing capital to companies for growth, and helping create investment products that benefit all types of investors. This allows individual investors to shape the markets by affecting demand and supply dynamics and influencing pricing. In addition, retail investors are also able to control how companies manage their business practices by voting in shareholder meetings. Finally, retail investors help make markets more efficient because they provide much-needed liquidity, which helps keep prices close to fair value due to increased competition among buyers and sellers. Final thoughts. Retail and institutional investors have an essential role in the stock market. Retail investors bring liquidity to the market by buying and selling stocks, providing capital for growth, and voting on business decisions. In contrast, institutional investors help create stable financial products that benefit all types of investors. Ultimately, it is up to individual retail and institutional investors to decide which investing strategies best suit their needs. With access to quality research reports and experienced professionals, institutional investors often have a higher success rate than retail investors. However, individuals can still be successful in the stock exchange. Whatever sort of investor you are, understanding how these two groups approach the market in different ways will help you make more informed investment decisions. Thank you for watching this video about retail investors. We hope you now have a better understanding of their important role in the stock market. Happy investing! Disclaimer: Moovmynt provides educational content only. It should not be taken as professional financial advice.